Hello everyone. The derivative product we have selected is fuel volume futures, and this presentation is also focused on the theme of fuel volume futures. Our presentation is divided into 6 parts: background, product introduction, potential investor analysis, trading strategies, potential risks, and summary. First, let's come to the background. In March 2018, China's crude volume futures were listed. Crude volume is an international energy trading product. With crude volume futures, it's possible to have a predictive judgment on the price of crude volume, reducing the risk of unpredictable domestic fluctuations in international volume prices. At the same time, the listing of crude volume futures not only provides domestic energy production, but also is an important part of the multi-level capital market, becoming an important force in China's financial services entities. There are 3 factors can affect the price of fuel volume. First, international crude volume price fluctuations. Fuel volume is a downstream product of crude volume. Its price and international crude volume prices are closely related. Second, shipping market conditions. As the end consumer of fuel volume is mostly ships, the strength of the shipping market will directly affect the demand for fuel volume, which in turn has an impact on prices. Third, environmental requirements. Marine Pollution Convention requires ships to use clean energy, which directly leads to a significant increase in the cost of bunker fuel, causing a huge change in the consumption structure of the bonded ship supply market, which in turn brings dramatic price fluctuations.
Next part is product. As you know, the product is fuel oil traded on the Shanghai Futures Exchange. The contract symbol is FU, and here is the contract, including all the general information you may care about. The contract size is 10 metric tons per lot, and yuan per metric ton is the price quotation. You may have noticed the price is exclusive of tax. The minimum price fluctuation is 1 yuan per metric ton, within 13% of the settlement price of the preceding trading day is the daily price limit. It's a monthly contract for the most recent 12 months. The trading hours include night market and day market. The last trading day of the month before the contract month is the final trading day. You may keep this in mind because this is a physical delivery futures contract. That means if you cannot dispose of this contract on the last trading day, you need to deliver 10 metric tons of physical fuel oil per contract to the venues designated by the exchange during the 3 consecutive business days after the last trading day. In this circumstance, the grade and quality of delivered fuel oil also need to be paid attention to. Throughout the contract, your greatest concern should be the minimum trading margin, which is 15% of the contract value. For instance, if the contract value is 1,000 yuan and your margin account has more than 150 yuan, you will be allowed to trade these futures.
Next, I will talk about the potential investor. Different types of customers have different bias on risk and return. We have 4 types of potential customers. The first type of potential customer is refiners and oil suppliers. In order to ensure a reasonable profit when they sell commodities to the market in the future, so as to prevent loss when the price falls, they can adopt the hedging method to reduce the price risk. The second type of potential customer is the shipping company. Because they are worried about the rise price of oil, in order to protect themselves against the rising price of oil when they need to buy, they can use hedging to reduce the price risk. The third type of potential customer is oil traders. They both buy and sell spot goods to customers if the number of contracts is not consistent and the timing is not consistent, there will be risk of them. The fourth type of potential customer is individual. They can increase their wealth by investing derivative products and reduce the risk of investing in other financial products. That's the end of my part.
In this part, I will introduce 3 trading strategies. The first one is hedging. Say for example, in order to prevent enterprises such as shipping companies from suffering loss due to rising fuel prices, when they need to purchase fuel, they can reduce price risk by adopting the transaction method of buying hedging. A shipping company can buy an equal number of future contracts, like 50 contracts, at January 16 and then sell the future position when buying the spot at February 16. In this case, as the growth rate of spot price is lower than the growth rate of future price, the company not only locked profits, but also made a profit of about 220,000 yuan due to the hedging operation. The second one is calendar arbitrage. Taking bull spread as an example, we can find that the price difference between FU2303 and FU2304 is 43 per ton at January 16. The holding cost of fuel futures is simply composed of capital cost, handling fees, and storage cost, which is calculated to be 42.86 per ton, lower than the price difference. Therefore, the spread will gradually converge to the holding cost. We can sell the contracts of the forward months and buy the same amount of contracts of the recent months to make an arbitrage. Conversely, if the price difference between adjacent 2 months contracts is less than the holding cost, we can buy the contracts of the forward months and sell the same amount of contracts of the recent months to make an arbitrage. Finally, individual investors usually use intraday unilateral position speculative trading, which is more risk than arbitrage, but there are many advantages, such as low handling fees, wider price limit, margin, and T+0 trading system. It's more suitable for investors who pursue high returns and high risks.
Well, this is risk analysis based on our strategy. Our strategy predicts that the fuel oil price will increase in the short term. However, the crude oil price recently showed a downward tendency, and the price of the Brent crude oil dropped from the $86.9 a barrel last week to the minimal $80.34 a barrel. The crude oil price fell linked to the low sulfur fuel oil price fell. The fuel oil price recently strengthened because the Iran and Russia export dropped in February 2023, and the global refinery utilization remains low. However, what if the Russia isn't voluntarily curtailing the more fuel oil price production than the market expectation, and Iran is boosting its fuel oil export? The supply will be increased, that the fuel oil price may drop. A lot of factors that may affect the fuel oil price will move into opposite direction as we expected. It's the shipping demand. As we know that the primary terminal consumption of the fuel oil comes from the shipping. If the shipping demand is far lower than the market expectation, the need of the fuel oil will also drop and the price will drop. For our boost through spread strategy, in most situations, boost spreads treat as no risk arbitrage. What if the price difference increased significantly for the boost strategy, and we must to close the positions throughout the physical delivery? And that is the risk. The carrying charge may offset our profit margin, and even worse, we may face the loss.
In summary, there are 4 main implications of fuel oil futures. First, fuel oil futures make it easy for a wide range of Chinese companies to use the local future market to hedge and manage risk, while keeping investor resources in the country. Second, fuel oil futures can fill the gap in the existing international crude oil pricing system and establish a crude oil pricing benchmark. that reflects supply and demand in the Chinese and Asia-Pacific markets. Third, the gradual maturity and increasing attractiveness of the fuel oil futures market will promote the use of RMB in the international arena, which will be conducive to the internationalization process of RMB. Fourth, the experience accumulated in fuel oil futures in terms of tax management and foreign exchange management can be gradually extended to other mature commodity futures varieties, thus promoting the full liberalization of Chinese commodity futures market. That's all about our presentation. Thanks for listening.